Good morning, good afternoon, good evening, whatever, wherever it is where you are. It is 7:50 a.m. Monday, the 3rd of August, where I am. I'm just going to fly through this economic update quite quickly because I want to get it uploaded before 9 a.m. I have to get it uploaded before 9 a.m. so if I make any mistakes here, just roll with it. I won't. So effectively, you're not hearing enough in the news, on newspapers, television, radio, about the sorts of things that we should be discussing in relation to the economy at the moment. A little quick bit about my background. My undergrad was in accounting. I studied some law before then. I've been majorly interested in macroeconomics since business studies in school, really, for over 10 years. And I've done a bigger deep dive into macroeconomic learning than I would say 99.9% of people over the last few years. In terms of the sorts of people who I'm getting from my content, Rose and Milton Friedman, Lynette Zhang and all at ITM Trading, Danielle DeMarco Booth, George Gammon, Ben Felix, Peter Schiff. I've read all his books, listened to countless hours of his podcast. It was actually his book, The Real Crash, that first got me really interested in macroeconomics. Robert Kiyosaki, Ray Dalio, Real Vision. The list is endless. So I'm not just some idiot with some silly opinions, and I'm making very logical, rational points. If you want to agree with them, if you want to challenge them, get involved in the comment sections. But things are going to start happening thick and fast over these next few weeks and months, and people need to be clued in as to what's going on out there and where we're headed. So if this content in any way benefits you, great. If you think that it might be of benefit to your friends or family, I would encourage you to share it, and that'll do. So we'll just jump straight into it. Lastly, I made about 6 videos at the beginning of lockdown. You can look at them in the YouTube channel. I've been correct in about 90 to 95% of the predictions so far. So there's some sort of merit that you can gain with that, and you can have some comfort that there's something that I know what I'm talking about here. So let's just jump into it. Increase in the money supply. Quantitative easing, that's that complicated term that you hear that effectively just means monetary policy, central banks printing. Federal Reserve in America, Bank of England in the UK, the European Central Bank. Central banks all around the world, whenever they engage in money printing, this is an increase in the money supply. You can see a smiley face beside 6 months and a not so smiley face between 18 to 24 months. Milton Friedman, Nobel Prize winning economist, sadly no longer with us. He used to discuss how an increase in the money supply throughout the last, I think it was something like 300 years worth of data we'll have in the UK and about 200 years worth in the US. But throughout history, an increase in the money supply, i.e. the money in circulation whenever central banks print more, feeds its way in a beneficial way to the economy in the first 6 months. It takes that first 6 months for it to flow its way through the economy and provide that stimulus to give reason to the rationale behind making the money increase in the first place. Now, if you think about where we are now, why I want to produce this video today now. Today is Monday, the first Monday of August. Lockdown started in March, April, May, June, July, August. We are now 6 months into this kind of giddy, euphoric type phase. Why I say that is the economy in real terms has been destroyed. Unemployment levels are higher than they've been in generations. All sorts of people are out of work. All sorts of businesses are closing down. Yet in a really strange way, things are kind of like chugging on, especially for larger businesses, and the real negative impact of what has happened to the economy hasn't hit home yet, I don't believe. Friedman would talk about how the increase in the money supply would only feed through in a negative way, in a real terms way. Well, it'll start now effectively, but it'll take 18 to 24 months for its full effect to take place. That full effect will come in the nature of an increase in inflation, not good inflation in terms of your house price going up, but the cost of goods and services going up. And also this will only be able to be paid for through an increase in your cost of goods, the cost of your goods and services, and through an increase in taxation. Who pays that taxation? We will get to that later on, but per head, percentage wise, it's effectively the working and middle classes who really shoulder the burden in terms of percentage proportion wise. We have a insidious financial system at the moment which rewards corporations with paying no or very little tax. Middle class people earning beyond 45 grand are being hit with 45% on anything that they earn in addition to that. In addition, if their national insurance contributions and different things like that they make. We live in a world where the corporation tax system is 20% max. There are different ways you can restructure your businesses to pay less. Capital gains, again, much less than income tax. And there are various ways that you can get around paying dividends, paying yourself in dividends. If you're elitely wealthy, effectively, you can get away with paying little or no tax, certainly on a percentage basis. So this is going to be problematic for average Joes over this next year and a half, as everything is squeezed effectively and the cost of things goes up, which is going to push down demand. This will I'll lead this into housing. I'll just quickly explain how this comes about in the first place. So up until 1971, the US dollar was on the gold standard. It was up until something like 1930. It was the UK, the pound was also on the gold standard, but basically at the beginning of the Great Depression, the UK came off it, the US stayed on it, and from 1945, the end of World War II, until 1971, when Richard Nixon took the US dollar off the gold standard. The US dollar was on the gold standard, and every other currency in the world was pegged to the US dollar, so was indirectly on a gold standard of form. What that meant was the Federal Reserve in America could not just print money, because every dollar was on the gold standard. Every dollar was backed by a certain portion of gold, meaning that they had to have a certain amount of gold in reserve if they were to print any more additional cash. Because of that, then other governments, countries, central banks around the world started holding US dollars as their reserve currency. And in 1971, it got to the stage where too many different countries wanted to exchange their dollars for tangible gold, and it got to the stage where it was kind of unsustainable for America to continue in that vein, so Richard Nixon withdrew the US dollar from the gold standard. From that point on then, central banks, primarily the Federal Reserve in America, had the capacity to print money without having anything in reserve as backing for it. Something like the goodwill of the American people, or some silly term like that, is effectively what it is now, the backing of a US dollar. So that's fiat currency. Fiat currency is currency that is not backed by anything tangible like gold or some form of precious metal or some form of cryptocurrency or whatever. So yeah, US dollar, euro, sterling, they're all backed by nothing, and that's why there's been this capacity from 1971, it'll be 50 years next year in 2021, where central banks can just print. Now, they didn't typically, at least initially. This feeds into my housing theory as well, that like house prices have effectively just constantly increased from 1971 from this happened, with obviously a couple of exceptions of corrections along the way. I wouldn't regard 2007, 8, 9 as the full crash on a more grandiose macro scale. I think that's coming. I see that as a correction in an otherwise upward moving bull market. But yeah, so what we have seen since the beginning of March has been the kind of last euphoric pump wave of money printing, when central bank's monetary policy is effectively coming to its end. There are no more kind of tools at central bankers' disposal. And it's the same with fiscal policy and governments as well, relating to taxation, but although they will start taxing more. So the two things that central banks can do are increase the money supply by printing and decrease the interest rate. And that's where we will start this housing interest rate point. Perfect. Okay, we have data for the last 320 plus years in the Bank of England. You can quickly load it up in a Google search. Just type in Bank of England base rate. It pops up straight away. You can see any changes for the last 320 years to the base rate. The average interest rate of the Bank of England for the last 320 years is 6%. The lowest it has been in the last 320 years, I think, was 2% in something like 1951, except for the last 10 years, where it's been less than 1%. And as of March, as of the start of lockdown, it's something like 0.15 or 0.1% now. Meaning that is the minimum lending rate, the Bank of England minimum lending rate, which they lend to ordinary banks, and then those banks charge a mini fee on top of that, and then they can give it to you and I. That is why credit is so easily accessible at such a low repayment interest rate, which is why you can get such cheap houses in terms of low mortgage payments, low payback deals in terms of buying cars on credit and things like this. So we're in a situation now where, other than going into negative interest rates, which is unlikely that it's going to happen, but no one really knows the ramifications of that happening, you cannot reduce the interest rates any more than they already are without going negative. Okay, we're looking at housing. Okay. There have been, over the last few years, recent generations, all sorts of things thrown at housing in order to maintain and continue an artificially created housing demand, which has continued this bubble, the speculative bubble of house prices always increase over time, through different things. One, anytime the interest rate goes down, it means that mortgages can be bought with a smaller degree of payback in terms of your interest payment. This bolsters buying, it bolsters demand, it in turn pushes up the price of housing. Credit with employment. Okay, until the start of lockdown, employment was higher, in theory anyway, than it ever was before. Obviously, if you're in a situation where you have a job, you can go into a bank and say, look, here are my monthly bank statements, you can see that I'm in employment, can I get a loan for a house? And they go, yeah, of course, crack on, enjoy, there you go, enjoy your new build, which everyone seems to be getting. There are also, additionally, there have been the last few years a lot of different government schemes, so loads of people have got involved in the Help to Buy ISA, co-ownership, even if you can't afford a deposit, although it's only like a 5 to 10% deposit that you need anyway. Like, it's like, no, I want a house, oh, I can't afford the deposit, but it's okay, the government are going to give me it anyway. And then more recently, the last few weeks, to try and again stimulate demand, they have temporarily put a holiday on the stamp duty that you have to pay on a new house. Now, the problem is the ammunition that the government have and that central banks have, there's none left. There's nothing left that can be done. And if you go out into the street now, you will see a lot of houses have for sale signs up. It's kind of getting to that uncertain stage where people are starting to think, well, maybe I should really sell this, or maybe I should downsize, you know, especially older families who maybe have a big house that don't really need it. But there's a dominoes-esque knock-on effect to all of this. Also, now that unemployment is much higher, although temporarily people and businesses are being subsidised to some degree by the government, it's going to be hard, if not impossible, if you're not able to show those monthly income statements, if you're unemployed, to get credit given to you in the form of a mortgage from a bank. So That in turn will reduce demand. Less people have less money coming in. The cost of goods and services is going up. The cost of taxation is likely going to increase. These are all triggers that are going to lead to a reduction in demand. Whenever demand goes down, prices will go down. And in housing, as in most markets, but especially in something as precarious as housing, as soon as demand and prices start going down, that will lead to panic and that will lead to mass selling. I discussed this on a previous video, but I think it's a good point and a good way of understanding it, so I'll repeat it. Peter Schiff, in his book The Real Crash, talked about a scenario whereby a rural pub landlord had, on a nightly basis, about 5 tenants that would come in and have a few drinks. Now, one summer, randomly he just came in on a Wednesday night and there were 50 tenants there, people just drinking beer. He was loving it. He was so busy pulling pints, chit-chatting, looking at the cash register, ching-chinging, that he failed to realise that they were all clowns. What had happened was the circus had come to town. All these sorry clowns enjoyed too much of a good drink, let's say, and they were in on a nightly basis. So he was so giddy and euphoric with the fact that, wow, demand has increased so much, that he actually went down to his local bank. He got a business loan. He extended the property because he thought, look, if I get a few more tills, a few more taps, I can serve more of these guys at once. I won't have them queuing. We can really bump up our revenue. And what he also did was he brought on a few more employees. He brought on some more staff. Now, what then happened was that was artificial temporary demand. What happened at the end of summer was the circus rolled out and left town. And what that guy had was his 5 initial tenants, they were still the only ones that were coming in. His revenue, his temporary bump in revenue went straight back down to normal. However, what he had was that debt obligation to the bank, which he had to pay. He needed to continue paying that on a monthly basis. Even now he had this massive excess capacity that he didn't really need, that there wasn't this like sustainable demand for. He also had these new employees that he needed to keep paying, or let them go, whatever. But now he was just back to square one, only with all this excess debt. By the same token, this entire phenomenon has been propped up by historically unprecedentedly low, I don't know if that's a word, interest rates, easy access to credit if you have a job, when employment was basically as high as it's ever been. And then all these schemes, they're just ways of kicking the can down the road and trying to keep this house prices will always increase over time phenomenon going. Even though no market in the history of finance, be it shares, gold, silver, cryptocurrency, housing, whatever, no market has ever just gone up in time, like without major crashes along the way. And the fact that like we've already within just a few years, 10 years or something, gone from the lows of 2008 or 9 back up to par and slightly above in many areas, that's not sustainable. That's a speculative asset rather than something that's like legitimate in terms of its increase over time. So this is worrying, and we'll get to solutions relating to that in a moment. Leading on from housing to the same sort of gear, the financial markets at the moment, monetary policy is the number one driver in terms of pushing markets upwards. Monetary policy being reduction of the interest rates and an increase in the money supply through money printing, quantitative easing, all this jazz. My first videos that I made, my first video, I made, I'll link it in the description below, was in September 2018. In my video in September 2018, I explained how we would have continued euphoria for the next couple of years and that there would be an utter financial reset collapse late 2020 or early 2021. I said that then. I still think that's the case now, a year and a half later, 2 years later, whatever, almost. When I started though at the beginning of lockdown making a few more videos, I don't know if you remember, but early March, all financial markets, whenever lockdown started, fell by 20 to 30%. On the news, it kept saying things about recession, Great Depression. if you look at any of the other economist channels at that time on YouTube, everyone was saying, oh, Great Depression, game over, whatever. I purposely made videos explaining that we were going to all-time highs because I knew that these guys, the Federal Reserve, were going to go through the roof with their money printing, and I knew because of Milton Friedman and guys like that, that monetary policy is the #1 driver for stock markets, and that euphoria always precedes a crash. We hadn't had a euphoria yet. We are well in the midst of it now. And one of the main reasons I'm making this video is because I do not want you to get sucked in. Apple went up by 10% on Friday past. We're in the full-blown last euphoria phase. I've already started seeing ads on YouTube and different things like that for people to get involved in real estate type ventures and to get more involved in share buying and things like this. And of course, if you hear of one of your friends making some money type deal, you might want to do the same and you'll get encouraged to do the same. Do not, unless you really know what you're doing, you're really confident and it's a quick in and quick out type phenomenon, you just keep yourself safe. Cash is king, okay? I see Apple's market capitalization as of Friday is $1.84 trillion. That means that at the current share price, the total value of all the shares at the current share price is 1.84 trillion. I believe that the trigger for GTFO get out of all these markets will be, as soon as you start seeing in the news in a week or so, or a few weeks, whatever it might be, oh, Apple has hit 2 trillion market cap. They will portray this as if this is some form of good news. They will portray this as if this is life back in the economy again. Get involved in the markets. No. The people who are in the know are getting out. They are unloading all their major shares to the postman, the average Joe who's getting involved now because the news is telling them to get involved now. Don't do it. Stay safe. Cash is going to be king for the next couple of years. Okay, shares, gold, crypto, housing, all acting as speculative assets. Right, this is where I was confused. Not confused, but the one thing I said I've been right consistently to this point about 90% of the time. The one thing that I've got wrong, and I wouldn't even say wrong, I still think it's going to happen, is gold and silver gold has moved from say $1,500 an ounce to about $1,900 an ounce the last few months, and silver's moved from about 15 to about 26 at its high dollars for 1 ounce of silver. I think these bad boys are tanking. I think they're all going down. Now, the thing is, historically, gold and silver have been a hedge, an uncertainty hedge that people use if they're worried about the economy, as they rightly should be. If they're worried that stock markets are going to tank, they generally would maybe buy some gold, maybe buy some silver type deal in order to hedge against that scenario occurring. However, shares been going through the roof. Gold and silver been going through the roof. Cryptocurrency more recently been going through the roof. They're all mimicking each other. They're all acting as highly speculative assets, not as hedges, not as safe havens, and even housing you can put in that bubble as well. That's concerning. What I've noticed is the dollar has been capitulating of late, and as a result of the dollar capitulating, these bad boys have all been going up. What I see ensuing over the next 12 to 24 months is I think there'll be a serious rush to dollars, and I think all these guys are going to tumble. So yeah, basically at the start of lockdown, whenever there was a crash across the board, there was a crash at the start of March in the price of gold and silver, the price of crypto, even housing, shares, everything went down. All stock markets went down between 20 and 30%. Because there was such a rush for dollars. People were being liquidated out of short positions and things like this. There was a rush for dollars. I think that was a kind of, what's the word? It was just a mini sign of what's going to come here now. as soon as we crash, there's going to be an absolute major push towards dollars. And there will be this period of cash is king. Now, the difficulty with the game of life here is that people want one black and white answer. What do I do? Do I buy Bitcoin? Do I buy gold? Do I sit on cash? It's kind of like you got to do one for a while and then do the other for a while. That's why you subscribe to channels like this. George Gallman, by the way, I'll link his channel below. He's like the cream of the crop of everybody. So he's only kind of come on the scene the last 6 months, year, and he's got like 160,000 subscribers. And rightly so. People are starting to get clued in, and that's probably going to tie into why this is all going to collapse with whenever. Economics is all to do with mass psychology as well. So when enough people realize where we're at, things are going to hit the fan. But anyway, yes, I believe that as soon as we start to have a crash, temporarily, there will be a major push for cash, specifically the US dollar. You're also starting to see things in the news at the moment about, banks mightn't accept cash and things like that. Don't buy it. Get your hands on cash if you can, if you're in the position to, especially US dollars. It'll be the safest place to be for the next year or two, and then it'll ultimately culminate in the eradication of fiat currency, I think. So whilst short term it'll be the best place to be, in a year or two you'll want to be getting hell out of it and getting real things like gold and silver and crypto. But we'll get to that in time down the line, assuming we're all alive and good. Okay. Yeah, long term, gold/Bitcoin eventually. Subscribe to the channel because we'll talk about that down the line. I'll get onto that last. Solutions. I would be remiss in my duty as a good Catholic to not say that the number one solution to everything is God. Without developing a relationship with this guy, the rest's irrelevant anyway. I was in, like, joking aside, it is kind of important. At the moment, Christians are possibly the most persecuted group in the world. Antifa at the moment are going through America cutting the heads off statues of Mary and Jesus. Like, I know this is kind of funny or whatever, it's like, it's not. People, whether you're atheistic, agnostic, whatever, you need to realise that our entire Western civilization culture has been built on Judeo-Christian values and principles, and if you just eradicate that, and if you just sit on the sidelines, we don't know what the ramifications of that are going to be, and I wouldn't be too overly optimistic about it. So the time for being in name only isn't really good enough anymore. I was in Mass yesterday, Sunday, and last Sunday for the first time since the start of lockdown, and I was definitely the only person under the age of 40 there. You can say that there's good reasons, that's a good thing, bad thing, whatever. Like, I just personally think that we need to get this guy more involved in life, and I'll leave that at that and stick to the economics from here on. But in a funny way, Warren Buffett, probably the best investor, most successful investor of the 20th and 21st centuries, the CEO, owner of Berkshire Hathaway, he would always say, whenever he's asked what's the most important thing in investing, Warren, he would always say, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. So by the same token, God, 2, don't forget rule number 1. Okay, leave it at that. 3, and I'm gonna do this in a way where I'm aware people don't have savings. I'm aware most people watching this aren't in a position to be buying gold and silver and crypto and all this stuff. So in terms of ordinary people who are just kind of struggling to get by at the moment, don't get into any more debt. That's step 1. No more debt. No more, I like this car and I can maybe pay it off over the next 3 years. At this interest rate type deal. Just don't do it. Don't do it. There's so much uncertainty in terms of like if you get into that sort of scenario where, say, you have to pay £300 a month for the next 3 months for a car. First, 3 years, just as an example. First of all, you're assuming that your income is going to continue for the next 3 years, and like, I don't think anyone's safe in different ways at the moment in terms of like what's going on in the economy. So you want to be getting yourself out of those debt obligation type scenarios as much as possible. We're all already in some to one or other extent, but don't be getting yourself into any more new ones. Don't be booking flights for holidays late 2021. There's a high probability most of these airlines aren't going to exist in a year or so anyway. Look, if inflation goes through the roof, if taxation goes through the roof, disposable income's going to go down. There's going to be a massive dominoes effect throughout the economy. You need to realise that. Like, I'm not talking about this lightly. I'm talking about this because people aren't talking about it. You don't hear this in the news. You don't hear this in the Nolan Show or BBC or CNN, RTE. You don't hear this jazz. You just hear, oh, the economy's starting to get a wee bit more buoyed now. Things are starting to look a wee bit green lights, green shoots. BS. But anyway, yeah, no more debt. Eliminate debt where possible. If you're in a position to, I don't say this lightly, if you're in a position to, and you can get your house sold now and figure out another way of being, I would recommend it, because I see a scenario where we go down by 80 to 90% in terms of housing over the next, 10 years, something like that. But it's not good. It's been far too speculative a bubble for far too long. It's been propped up, whatever term you want to use, by ridiculously low interest rates, which will eventually return to type. They always do, they always have throughout history, by all these government schemes, and by just the fact that, like, it's been going on for so long that, like, my generation would look to their parents' generation being like, I got this bit of money, what should I do? Oh, you should get a house. House prices will always go up in time. It's a really unfortunate scenario that we're in, but this is what I think is going to happen, so at least consider it. I know that most people that have a home aren't realistically going to get rid of it. One, because rent is so much dearer than your mortgage will be anyway, so I get it. And if you're sort of, I would encourage you in your mind to be like, right, well, if I'm here, I'm going to be here long term type thing, because if house prices do go down, I'll be in a position where the mortgage might be more than the actual value of the home, so I kind of have to stay in the house type deal. So a lot of this, in terms of strengthening things, I'll get to that in a second, just quickly, but in tough times you need to strengthen your mind physically, and every way that you can strengthen yourself, you need to prepare for dark times coming effectively. And if you're strong, you can endure anything. So prepare mentally for what's coming. But as interest rates are so low at the moment, if you're in a home, if you have a mortgage, what I would do is, today's Monday, I'd get my ass down to the bank on Monday today, any day this week, or just at the earliest possible opportunity. Have discussions about remortgaging. Now, if you're remortgaging to a fixed rate or to, what I would encourage you to do is get the longest, this is educational purposes only, not financial advice, but what I would do in that scenario is have a discussion with the guy at the bank who can extend or give me the longest fixed rate interest rate possible. I think 5 years is the max generally if you're looking online. Maybe if you go into the bank in person, you can get a 10-year interest rate. I say that because eventually interest rates, I do believe, will go higher. So while now interest rates are at like 0.1%, make the most of that opportunity to keep your interest repayments as low as possible for as long as possible. Even if it means that you're kind of being penalised short to medium term, grab it while it's so low. Get your mortgage payments down and fixed, because if it's a variable rate and the interest rates go up to 6%, your mortgage rates or repayments are going to go through the roof in comparison to what they otherwise could be. Think about that. 6, oh cheapers, we're really nearly there. Community, this is the most important thing in many ways. Throughout the Great Depression in the 30s, throughout different difficult times in history, you can't just look after number one. You can't go it alone. You can't just, the only way people get through scenarios is through looking after one another, looking after your community, being there and helping out wherever and whenever you can. Whatever skills, it's kind of like everyone's got different skill sets and can do different things well and can almost like barter and trade their skill sets as much as they can in normal currency. So you need to start establishing, improving, strengthening, reconnecting, developing relationships. Things are polarized. If you have a right-leaning or a left-leaning tendency at the moment, there are so many different issues going on in the world where things are sensitive, they're polarized, and people kind of withdraw into themselves. They only want to speak to people that kind of have the same opinion as them. And we've developed to this stage where there is no dialogue, there is no healthy discussion between people who disagree. And it's this really weird phenomenon where if I'm right leaning or if I'm left leaning, it's kind of like, I'm right and you're wrong and you're an idiot. I don't even want to hear your point because you're wrong. I know you're wrong. So there's a serious audacity, arrogance and rudeness. The only way we're going to overcome the obstacles that are coming thick and fast is with love, with compassion, with empathy and respect. So I would encourage you to start with you. Start with you. Start developing your relationships with your family, with your friends, with your local community, then with your wider community. And it all comes from love and respect. So we need to do that more. We need to develop and improve community more. It's been the one silver lining that I've seen from this entire lockdown period is the improvement in terms of community relations. You know, you walk past someone in the street and you say, hello, how are you doing? And I've never really had that in my lifetime, and that's nice. So more of that. Okay. I'm going to go against everything that I've just said. If you are not risk averse, if you are a gambler effectively and you like to look for opportunity in the chaos, there is probably an opportunity to, if you have some money that you can invest, probably an opportunity to make some money in different things. Like, you know, there's different pharmaceutical companies and face mask companies and things like this which have done well throughout the last few months. The one thing, and I literally mentioned this in my first video in April or something like that, March possibly. The one share, that's their ticker symbol. Not that I would recommend, but that I am in, that's a bad tick, is VRE, VR Education. So it's a company from Waterford, Ireland, and this is just an example that I want your creative brain to get processing. They have a virtual reality platform called Engage where you can do remote working, remote learning. You know, universities are buying or subscribing to this platform. HTC, the major Taiwanese electronics company, phone company, have just bought 20% of the company and have made various deals with them. They're making all sorts of new deals. Basically, it was as low, the share price was as low as, do you know what, I'm completely gambling here because it took a while to write and I'm going to ruin everything here, but I only picked this bad boy up yesterday and there was no duster so that I could buy in the pound shop that I went to, but this geezer was there, so I just want to show you this quickly. There is a mathematical sequence. I was listening to a song yesterday by Nora En Pure called Fibonacci. He's a bit dirty now. Sorry, fella. And it was coincidental because Fibonacci is a type of number sequence that's used in trading theory, in technical analysis, to basically help traders know when to make an entry or make an exit from their current position. They call this thing the golden ratio. It's 61.8%. Small bit of financial education here. So effectively, once a share goes up in value by a certain amount, if it retraces that move by 61.8%, it has hit the golden ratio, and that is effectively an indicator for traders to buy. So this share, VR Education, was as low as 4 at the beginning of March when everything's really kicked off in terms of the crash at lockdown. March 2020, the share price was 4, right? By June 2020, the share price was as high as 25.8. Woo! I'm really bad at writing, by the way, sorry. But yeah, huge move, huge move. However, since June, when it was at 25.8, it moved down to a low of 12.1. 12.1. the 61.8 retracement, the Fibonacci retracement, was actually 12.3. So that was the kind of buy trigger. And as of today, Monday the 3rd of August. As of today, started today anyway, it's 13.3. So 13.3 is basically half of its high in June. And I think that if one industry is going to continue to do well, it'll be an industry like VR. And that VR education firm is primed to take advantage of scenarios where there is more of a requirement to work from home. Also, Oculus produce headsets. Oculus are owned by Facebook. HTC, who own 20% of this company, produce headsets, and all sorts of new headsets are coming out over the next few months. I imagine by this Christmas there could be some form of euphoria in relation to VR. So that's something to think about, but what I'm telling you in general with this point is pandemic friendly shares. If you are to get involved with things at such a risky, precarious time, be really creative and smart and buy low, don't buy high. So if people are going, oh, Apple's gone up loads, you don't buy something that's gone up loads. You buy something that's been battered. That's how you make money. Anyway, yeah, that'll do. Political system / tax. Last thing, and this is for another day, but there's such an increase in the dialogue at the moment that like we should be moving towards socialism, and the capitalism's bad. One, we don't have capitalism. We do not have capitalism. Capitalism is free markets, minimal government interference, low, if any, taxation. Income tax is 45% plus national insurance contributions. That's more of a socialist state than it is a capitalist state. The problem is that we have crony capitalism. We have big government being lobbied and benefiting through crony, fraudulent, arguably measures, big business and big banks. That's what we don't want. My ideal world would have, and I'll get to this in a later video, but the system that Henry George, a guy who wrote a book in the late 20th century, was called Progress and Poverty. Other than the Bible in the last 20 years of the 1800s, it was the most bought book in either the world or America or something like that, which is ironic because you've never heard of him, no doubt. But he suggested that the best form of taxation was just one tax, not income tax. It was a tax on your land, the unimproved value of your land, meaning that if like neighbour A had a plot of land and neighbour B had a plot of land, neighbour A did nothing to his land, just a wee bit of land, and neighbour B made this like humongous skyscraper, they would both be charged on the same amount of the same, because it's the unimproved value of land. Anyway, Albert Einstein said that it was the least bad tax ever put forward. Milton Friedman loved it as well. People on the left and people on the right both can get behind that form of taxation. So I want to look more into it and suggest that it should be used. But at the moment, if you listen to what's going on TV, if you look at politicians all around the world, people are suggesting more government, more push towards socialism. I don't know if you know, right, but there was this guy called Hitler. He was kind of bad in the 20th century. Under Stalin, more people died in Russia than died under Hitler. Under Mao in China, more people died than died under Stalin in Russia. Anywhere where there's socialism today, it fails, and badly so. Do you know what's happening in Venezuela at the moment? Like, things are really bad anywhere there is socialism. Capitalism is not perfect, and it's certainly not what we have now. But if we move to a smaller government, lower taxation, higher freedoms type scenario, that's the best opportunity for people to do well and to look after one another. So we'll get to that in time. But yeah, we need to strengthen mentally, physically, emotionally, spiritually, build our relationships, more love, more empathy, habits, eating. Look at food as a fuel source for strength, for mental, for everything, not as a pleasure type tool, and not drinking on the head, because these things are going to be what wipe out people who effectively give up and bury their head in the sand over these next couple of months and years. We need to be better than that and encourage each other to be better than that. Fuck it, we're done. Subscribe. Much love.